Good morning, everybody. This is Todd with the Forex Nitty Gritty Insiders Daily Video. Hope you're having a great day today. Um, we've ran into some pretty choppy movements in the market as of late, and that makes it sometimes more difficult, especially when we're looking for those deliberately trading markets in order to enter into using the simple trading method. Now, unfortunately, the market doesn't move in a perfect fashion every time we want it to, and so we have to deal with the fact that there'll be times when the market is not moving just perfectly like we'd like to see it. So, how do we deal with times when things are not moving the way that we want them to? Well, generally speaking, we don't want to stop trading. What we want to do is we want to lower the amount that we're actually putting into the market and giving the market a chance to take from us. And as we have discussed before, what we look for is the concept of position sizing, through our risk management. And our position size, because we are basing it off of the amount we're willing to risk in the trade, can be consistently determined as we use a percentage-based way to do that. Our maximum that we should take is 2%. And this is usually after the fact that we have used a strategy that we're comfortable with, that works for us. And as we are really to that point where we know what is happening with our trades. So that means that we generally are going to be trading less than that. And even if we are comfortable with our trades, if the markets are not deliberate, we're going to lower that down. So we could go to 0.25% if we wanted to, or lower. Just depends on how comfortable we are with our trading. So what I'm going to do is, for example, let's say that we went long right now. We entered into our trade. Our entry is going to be at, we'll call it 1.0030. So 1.0030. And our stop loss initially is down below our most recent low here, for example. We're going to put it at, we'll make it an even 1.0000, which means that our risk, pip-wise, is 30 pips. If I have an account equal to $10,000, and I'm going to risk 2%, that means that I'm going to risk $200. Well, if we're dealing with mini lots, and we'll go with the idea that we're dealing with about $10 per pip, I would take 30 pips or $30, because each pip is worth $1, divided into 200, and come up with the number of lots, or the amount of lots that I'm going to be dealing with. So 200 divided by 30 is going to be 6 lots we'll go with. We'll round down always to stay lower than those. So 6 lots, or which are mini lots. If I was going to do 1%, my risk would be $100, and my lots would be about 3. If I was going to do 5%, my risk is going to be $25. So I would not be able to take a trade. Now, it's okay if we are sitting in a position excuse me, where we're not able to take a trade. And my suggestion would be that we just skip a trade when it extends beyond the amount of risk that we want to take. Unfortunately, what a lot of people do, well, they'll say, I'm going to be doing 1% risk, and then they'll run the calculation, and they'll determine that they don't have enough, their risk is too much, and so or not enough, and so they'll increase it to 2%. So instead of going with what the math and the numbers tell us, they change their parameters and add to the amount of risk that they're going to take. So if things are more volatile, consider lowering your risk from that maximum of 2% down to a level that you're comfortable with until the markets become a little more stable or deliberate in their movements. And sometimes that's hard to tell, but you can generally tell if it's too choppy and you need to lower that. So take some time to play with that. If you have questions, feel free to let us know. If not, we'll be back tomorrow to take a look at how the market continues. So until then, have a fantastic rest of the day, and we'll talk to you soon.